household stock ownership is basically at an all-time high percentage, right? So, you've got stocks very richly valued, as you just said, and you've pretty much got everybody in the boat at this point in time.
Everybody's in, and the reason I sent you this chart is because we overlaid it with debt to GDP. You got a lot of debt. You're going to choke down the economy and choke down the GDP. You have to, because you have too much debt, and individuals can't see it. They just keep buying the indexes and pushing more money in the market. And if you look at the largest ownership in 401ks, it's the people that are 50, 60, and 70. They have all the money. And I feel for them in some ways, because I don't think they're even thinking about, well, what could happen if I have something serious take place here.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Dazed and confused is how a lot of regular investors are feeling right now. Stocks have bounced back from their April lows, and optimism is back on Wall Street. I've certainly interviewed several experts who are feeling pretty bullish right now. But that doesn't mean there aren't reasons for concern, technically, fundamentally, as well as on the macro level, especially when major news bombs are dropping in the headlines nearly every day. How's the average investor supposed to navigate such a chaotic market? For seasoned expertise, we've got the good fortune of welcoming back to the program high net worth financial advisor Ted Oakley, managing partner and founder of Oxbow Advisors. Ted, thanks so much for joining us today.
Glad to be here, Adam.
Well, very glad to have you here, Ted. Lots to talk about, both in terms of what's going on in the markets, as well as there's one or two things that your firm and mine are cooking up in the near future for folks. We'll get to all that, but there's a lot of wood to chop between now and then. Why don't we kick it off with the direct question I've been asking a lot of guests recently. I'd love to hear your answer to this. Was the market drop that we saw in March and April, was that just a correction in an otherwise still intact bull trend? Or was the rebound that we saw in May a classic bear market rally, one that's perhaps poised to roll over and just pull the rug out from under investors?
Well, we said for some time, Adam, that we started saying this a year or two ago, that we thought this decade would be one where you would just go up and down a lot. You would, and even maybe make new highs, but then you'd give it back, and then you make, it'd be one of those where you wouldn't be in a brand new bull market. Even if you went up 20% or something, you're not in a brand new bull market because of valuations. So it's not surprising that this happens, because individuals and everybody else is trained to, let's buy it when we can, because we're going to go right back up. And it's all, and in their minds, at least, it always happens that way. So these swings probably will be indicative of what you'll see the next 3 or 4 years, in my opinion.
Okay, so in other words, you think that we're sort of in a volatility channel where there's going to be swings up, swings down, but it's not necessarily going to be a defined trend, perhaps one way or the other, bullish or bearish.
No, I mean, if you look at the low from 1974 up to 1984, you made some minor new highs in the averages, but then you give it up for 20%, just like you did in April, really. And then it would go back and forth, but every time you didn't make major highs. In other words, you wouldn't be taking the market, in our opinion at least, from, say, a 6,000 S&P to a 12,000 S&P. They're not that kind of thing, but we could see that's I think a sign of the times, and I think that'll be with us here for a number of years.
Okay, well that echoes what our friend Felix Zulauf predicted, I think at least about a year ago or so, that we'd entered what he calls the decade of the roller coaster, right? Big ups, big downs, but look at it with the scope of history, there's going to be a lot of sideways in there.
Well, I think so. I mean, I tell people, if you look at January of 2000 all the way through January 12, the S&P didn't, I think it averaged 1% a year, maybe nothing. It didn't go anywhere. And I think people, though, have gotten spoiled since 2009, this last 15 years, and they're like, well, everything goes up and it's all linear, so let's just get on board.
Right. So we've talked a lot about this, you and I, but also a lot of other experts on this channel, that era that so many investors have gotten accustomed to, and many of them kind of grew up in it. It's almost all they know.
Yeah.
the passive investment strategy worked fine, right? Hold and buy the dip, right? Um, so the counter argument now is that we're in a new environment, one that's going to behave the way you described, and that active management is going to play a much bigger role. That you really want to, to a certain extent, get out when the market's richly priced, get back in after the market's corrected, and you can still actually have a pretty good performance over time with an active strategy, but you got to manage it actively versus just do the passive ride, correct?
That's true. You have to know what you own or what you're going to buy. That's one of the reasons I feel a bit sorry for our individual investors and their 401ks and regular. They're always in the market and they just keep on buying and they never think about whether it's a good buy or not. They just buy,
Hmm.
and that's what they've been doing for a long time. And they're really just sort of whistling down the road, not thinking about risk. But, it always has some risk to it.
All right, so we're going to get in this discussion to Oxbow's market outlook and how you guys are positioning for it. But before we get to the granularity of those details, let me just ask you this, Ted, because you've been in the business for a good long while. How do you invest today in such a headline-driven environment, right? Some advisors I talk to like to look at technicals, some obviously look at the fundamentals and valuations, but in a market where everybody's macro outlook can change on a dime because there's big news geopolitically, Russia, Ukraine, whatever, or trade between US and China, or tariffs on or tariffs off. There's just so many news bombs, as I said in the intro, that can change people's perception on a dime here. How do you trade in this? I mean, do you take that into consideration? Do you just ignore it? How does one stay sane in this type of environment?
Well, it's interesting you ask, in my early years, which is 45 years ago, you would, I tried technical analysis and you look at the macro strategies, look at that sort of thing. But what it really came down to, and what I learned early on is you have to own a business, and a business is a stock. It's not an average or a fund, but you own a company and you can take an income statement, balance sheet, cash flow statement, and you can make a case for owning this company. Even if it was private, you'd make a case for owning it. To me, that's how you invest in this atmosphere. You make sure that the things you own are going to be the things that you would own, even if it was private. And I think that's what people probably forget. You have to know what to own.
All right, meaning, and this goes back to sort of the active, you're not necessarily buying a sector or buying an industry. You really are doing the work to try to find the wheat, separate the wheat from the chaff, the company that's going to be, have good growth prospects for the long run, no matter what the short-term market distortions might be. Almost sort of a Buffett-esque like approach.
Well, in a way, I mean, I think Mr. Buffett basically buys a lot of brand names, and that sort of thing. He likes that type of thing that's branded. It's not so much with us. We'll take a service company that does really well. I mean, we've owned Visa and MasterCard for many years, and those are basically cash flow businesses. When you buy them right, they don't have to spend a lot of money on plant, property, and equipment, and it's just a cash flow business. It's all it is, and that's how they make the money. And I think that's why those companies have done so well over the years. But it's that type of thing for us. We're looking for a company that we can say, this is a good value here. We can make some money on this the next 5 years. And we're usually looking at price to cash flow a lot because cash flow in any business, private, public, oil and gas, real estate, doesn't make a difference what it is. Really, cash flow is the most important thing in a business.
Okay, so obviously at Oxbow, you guys have your own process for identifying, the prospects you might want to invest in, buy their cash flow and whatnot. In this market where valuations have been so rich, how is cash flow priced these days? Are you finding good values out there, or is this more of a time where you're more waiting for lower prices to get that cash flow at a better value?
Well, you can find them. I mean, we screen for, we have about 300 companies we would like to own that are good companies. They've got good businesses, but they're not always inexpensive, for example. And so if we have one of those companies, but we're always screening them, particularly they'll fall into a certain area. Like I'll give you an example. In the last couple of months, really energy, oil and gas exploration companies,
Yeah.
they've really gotten cheaper. They look right to us for the next 5 years. Now they may not happen in the next month or two, but all of a sudden their dividends are 5%, 4%, 4.5%, and you can live with that while you wait on that because oil went from it got cut in half. It went from 133 to 60 in 3 years, and so now that's how you start to look at these things and you make a case for it. But in every company, you can get a pretty good price to cash flow analysis. And when you get that, then you know where you're headed. And that's one of the things we said for example, the gold miners a year and a half, 2 years ago, their price to cash flow numbers were insanely cheap, really, really cheap. And that's why they've done so well the last year and a half. But you have to look at that when you go through the company because there's a place to sell them too. That number gets overpriced and you take part of it off. But that's what we tend to look at when we're screening.
Okay. So have oil and gas companies gotten so cheap that you guys have actually been making some active additions to your portfolio over the past couple of months?
In the last month, we bought Chevron on a 5% yield. We bought Matador, which is a company we really like, a company in Texas that we really liked. It's mid-sized, but we really like the management, like what they've done. We bought, you're back at Conoco, which is, a great dividend too, a good company. And so those companies fell into spots for us where we felt like, now's the time to own those. And now again, we're looking out over the next 6 to 12 months or longer, but we think that the time is right for those. But there
Okay.
are other things we bought too. I don't mean to imply that's all we bought, but as an example, it's just one of the most recent purchases we've done is Yum Brands. And if you talk to anybody, they love Taco Bell, but it's a great brand though. They do pizza. These companies are good. I mean, they do the right kind of business, and finally they get cheap enough to where you can own them. Now they don't pay a big dividend, it's 2% dividend, but still, it's at the right price for us, and so we'll see. We'll see what happens with it.
All right. And I just got to ask because you mentioned them earlier, the precious metals miners, they aren't as cheap as they were a year ago. And you said, hey, there comes a time where you need to know where to sell this stuff. This is just a check-in.
Yeah.
I don't assume they've gotten to that point yet, but you tell me, you're still riding them or are you starting to sell them?
Well, the thing that we feel about the miners is they're still cheap on a price to cash flow basis. And sometimes you'll find a little gem about, I think it was probably 5 weeks ago or so, 6 weeks, we bought, we own other miners, don't get me wrong, but there's a company called New Gold. It's a small gold. It's about $4.70 a share. But when we were looking at 26 and 27 earnings on that company, I mean, this is a company selling at 3.5 times 26 cash flow on $2,800, $2,850 oil. I mean, gold, and gold's at 3,300. So, we had a buffer there for that. And of course, that company's gone up since then, but it's still cheap. It's still cheap, even at this price. But the miners, they could sit back in here. It wouldn't surprise me, by the way, Adam. If they do, if you're a long-term holder, you don't want to get shaken out here on a 15% decline or so, because probably if you look out 2 to 3 or 4 years, you're going to be glad you kept them.
Okay. All right, great. And you anticipated my next question, which is, it sounds like you think that the precious metals sector, metal and miners, still has room to run in this current bull market for that sector.
Yeah, it goes back to the thing, we like commodities for the long run. And I know a lot of people say, I don't want to own a commodity company, but still, if you believe that the dollar is going to decline and the country's debt is going to just keep on in a runaway mode, which we think it is, then you want to own some commodities. You want some metals and real estate, and you want to own some fertilizer and anything that's a hard asset right now.
All right, and that's a good segue to this next thing I wanted to ask you about, which was your outlook on inflation. This and the direction of bond yields, because they're kind of linked, still remains the single most topic I see the greatest disagreement on with the people that I interview. And like I just to pull some names, I interviewed Jim Bianco last week, and he definitely thinks that inflation is going to be a lot stickier than folks would like, and bond yields are going to go higher as a result going forward from here. Um, Obviously, if you look at things like, all the headlines around tariffs and the fact that the economy, you look at GDP now, I think it's now at like 3.8%. Some people are thinking, oh my gosh, it's starting to run really hot. So, obviously there's the inflation camp. But then, there are plenty of people on the disinflation, deflation side. Stephanie Pomboy, who's on my channel biweekly, definitely thinks that way. But our good friend Lacey Hunt, he's the interview that I released before this one, Ted. Um, he thinks deflation is firmly in the driver's seat. He's very worried about um, the front running of the tariffs now that they're over is going to leave a big air pocket, both in terms of money supply and just economic activity. So anyways, I'm just curious, do you have a strong opinion one way or the other in terms of your inflation outlook?
Well, I could see both of them being right. I don't mean to answer that, but I could see them both being right. The last time I saw you, was a few months ago, I mentioned we were trying to trade the long bond. Well, we only made a point or two and sold it. It wasn't going to work. And I think, and we've been saying along now, like it's going to be hard for people to own the long bond. I believe that's a tough time. The only reason it wouldn't be and rates would go down is if you have a recession. You have a recession and they're going to go down because the Fed will come in and do that. Unfortunately, it was set up to what Jim Bianco was talking about, though you'll go out a year or 2 or 3 years and you'll be right back in the soup as far as higher inflation. By that, I mean, 3.5 to 5. And
Hmm.
I think that's the thing. And a lot of these, they could be right on these lower rates, but it's because you break the economy and you also break the market. And you know what the Fed will do. I mean, this country's living off the stock market. So they'll be right in there lowering rates if that happens. And so they, in a way, they could both be right. It just depends on what happens first, I should say.
Okay. Well,
But I wouldn't
Lacey,
I wouldn't loan the long bond though. No matter what, I wouldn't. Even if you pass up an opportunity on it, I think in the long run, the next 10 years, you can't own long paper.
okay. That's an important caveat there, right? Next 10 years, watch out. All right. So that said, I assume I think last time we talked, you had a good deal of client capital, at least in your kind of conservative income strategies on the short end of the bond curve. Is that still the case?
We do. All of that's less than 2 years. We won't buy anything that's not yielding more than 4 and within 24 months. So a lot of what we've been buying is 12 months, 15 months, 18 months. A 2 year vacillates, it'll be up around 405, then it drops back to 390. So we haven't been able to buy as many 2 years, but we've locked in money at 6 months, 12 months, and then we have a lot of floating rate as well. So we figure that if we go into recession or something changes, we've got enough yield to get us through the next year and a half. And so if that's the case, hopefully we wouldn't be in a recession for a year and a half, but
Right.
not that you could, you can't say you can't do it, but I don't think you would. So we would be okay through what I call through the valley.
All right. So sounds like you've got, some, what do you want to say? Just you've done some pre-gaming that, okay, if the economy does go into recession, we've got this lifeline and the yields that we already have in the portfolio. Lacey, just FYI, believes that risk of recession is over 50% at this point in time. And folks, if you want to hear why, go listen to that interview with Lacey. It's a really good one.
I
But
have a lot
yeah,
of respect for Lacey. He's a good friend of mine, and I don't ever rule him out for sure, because he's been around a long time and he's a very, very well thought out, well educated man.
yeah, there's a lot of people that say, look, Lacey's been saying this for a long while, and is he just sort of at this point kind of a relic of an age that doesn't apply anymore?
Uh,
And sure, that could be possible, but I think there's also a very good chance that Lacey is representative of the forces of economic history that prevail. And the fact that they haven't returned yet doesn't mean that they won't. And oftentimes, as they say, reality bats last. So I would say you discount Lacey at your peril.
and you
Um,
know what, Alan,
but
Adam, I was going to tell you on Lacey, they forget about the 30 years he was right. And a lot of people in that 30-year period kept saying, oh, that guy's crazy. It's not going to happen. And so I always have a lot of respect for Lacey. He's a great guy.
I totally agree. So, you know, history will tell from here whether we get a recession or not. I agree with you, Ted, that if we do, it's probably likely to be shorter versus longer simply because of the reaction function these days of the central planners. And on the day we're talking, there's an article or a headline out in the news that there's dissent now within the Fed as to how quickly they should be cutting. So it seems like, Powell's, hey, I'm going to remain data dependent. We're not going to move until the data tells us to. At least from this leak, sounds like there are some members of the FOMC who are saying, no, 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 we need to get out ahead of this. And Lacey would agree with those folks. And I talked with him. He said that Powell is kind of earning Trump's moniker of too late Powell these days. So anyways, we'll see what happens. But Lacey did say something that I want to get your thoughts on here because it could be one of the reasons why a recession could happen. He said corporate profits dropped 100 billion in Q1 per the BEA's IRS-based data. So, he said that it reflects weak demand outside of aircraft deliveries and AI data centers. So, Lacey was basically saying, hey, at the end of the day, stock prices are all about earnings expectations, and corporate profits are starting to look a little weak. Now, I've heard from some other people, corporate profits are doing great, but they may be looking at the average there, which is propped up by these two big sectors I just mentioned. Do you have an opinion on where corporate profits are headed?
Well, one of the things that I sent you, one of the graphs I sent you had to do with the trailing 4 quarters, and people forget about it. It's not so much that they're up year to year; it's the rate of change. And if you look at the last 4 quarters, they're up, but it's declining up. Okay, and I think that's what people forget to understand, is that they're on a move to decline, meaning that you can't necessarily, I'm just using the forecasted too, by the way, the actual was up through, but if you take where we are and the forecast, it doesn't look like we're going to go into some sort of super profit mode. And I think Lacey will be right on that as far as earnings. They will be, the rate of change will climb. Now they'll still be up, but they won't be up 11, they'll be up 7. I think that's the difference.
All right, so obviously that's one thing that could get us into recession if corporate profits start struggling here. Like I said, history will tell. I don't want to get too wrapped around the axle here, but it is interesting to see that the impulse there, the growth impulse, is slowing. So now there's a lot of other people. That's sort of looking backwards. There's a lot of other people who are thinking, hey, there's so much uncertainty getting injected in the system right now by the disruptive policies of the new administration. Obviously, probably the greatest example of that is the tariff wars that are going on right now, and tariffs on, tariffs off, reciprocal tariffs. The math of the reciprocal tariffs caught everybody by surprise, and this changes, like I said, almost on a daily basis going forward. So I'm curious. We don't necessarily have to get stuck in the weeds of it, but at a high level, let's just take everything: tariffs, deregulation, tax cuts, big beautiful bill, shrinking government, Doge, all that stuff. Do you have an opinion one way or the other on both the policies of the new administration and then perhaps on the execution of those policies, if your opinion on both differs?
Well, I do. I mean, we look at the companies, but if I'm looking at what they're doing, really, it's interesting. They've basically thrown Doge out the window. They didn't save much money and sent Elon Musk packing. He's gone. And so they put that on the back burner now. And then they're bringing a bill, which is interesting to me, doesn't cut anything, nothing. In other words, we spend more money, we take on more debt. So this whole thing since January 1 is right back where they started. There's no difference in it. And we're doing the same thing we do as a country. We have a Congress that is completely inept and has been for 30 years and will not take the steps to really take care of costs. And that's where we are. And they haven't done it this time either. And it just looks like we'll be right back in it where we'll be, selling more bonds, driving the rate up. And that looks like it's going to go on and on and on. That's what it looks like.
All right. So you're more sort of hey, end of the day, no matter what you call it, it's going to be kind of more business as usual.
Well, it is right now. If you look at it right now, it's business as usual. I mean, you can, if you look at I'll give you an example. If you look at the up move in May of the S&P 500, there were 4 days that accounted for that, and every one of those days was this administration saying, "Oh, hey, it's not this thing is not going to be as bad as we told you before."
Hmm.
That's what happened. I mean, for people investing like that, I don't understand them, but they drive into the markets and it makes it look that way. But I'm just saying, on a country basis right now, we're we're not getting anywhere. In fact, we're not saving any money. We're not doing anything but running the debt up again with the new bill, and so we're right back where we were January 1. They can't tell me right now that there's anything coming out of here that's going to be fantastic.
Okay, so if we're sort of in still business as usual mindset, just heading back to the markets for a moment, well, what's been driving the markets over the past bunch of years have been the Magnificent Seven,
Yeah.
right? And they've certainly performed well since the April bottoms. But I believe you sent over a chart here about their free cash flow. Um, I think we're seeing some trends there that are not quite business as usual. Is that true? Are they not looking as healthy as they have before as a sector?
Well, I think people chase them, Adam, but they're not. And now you look at Nvidia; it's the same price it was a year ago, almost in June. It was 140 last June. And so, and everybody keeps, running it up and down, but really they're not making a lot of money on it. And then if you look at a lot of the others, they're lower than they have been in the last 7 or 8 months. Uh, and it may be something like a Netflix or something, but generally that group, if you look at them, their cash flows are declining. As a group, their cash flows, and they've gone negative. And it's not abnormal, because when you're in these kinds of companies, um, if you go back, for example, and look at the last 6 quarters for Nvidia, every one of those quarters was up, and was up nicely. Don't get me wrong. Uh, but instead of being up 400% like it was 6 or 7 quarters back, it's up 75 or 80 now. See, that's a declining rate of growth. I know that people are going to say, well, it's up big. Yeah, but it's declining is the point. And that's what's happened with a lot of these companies. And so basically on a free cash flow growth part, and remember, they've had to spend a lot of money on AI. Um, if you take Nvidia out, they're negative. Their cash flow's gone negative.
Yeah, I mean that's what's amazing about this chart you have here is yeah, their free cash flow growth has been declining. It's been positive, but less and less positive over the past several quarters. But now it's currently in negative, what, negative 11% over the last quarter?
That's true. And what happened is, if you look at the same thing was happening in 21, they ran all the prices up too high, but they weren't really making that much money. And the same thing happened, and then you bottomed, and they ran them again. And 22 was a down market, so they got cheap again and they came back in. But it's just part of the situation. But I think people have to be aware of that, because they keep chasing momentum. But I'm not certain if they look back over the last 7 or 8 or 9 months, they really haven't made any money. Is the thing.
Um, all right, well, so I guess that gets us just to sort of a general valuation question here, where you said that it sounds like, if I heard you correctly, it's a market where, at least for your list of sort of the 300 companies you've determined you'd love to own, if you're patient, somewhere in there, every so often, there's a sector that gets undervalued, and then you can maybe find, some stocks that you can pick up at the ratios that you want. And you gave us some names in oil that you recently did. But for just the market in general, now that we're getting back up near S&P 6,000, I know when we talked at the beginning of the year, Ted, you had some really strong concerns just about the general level of overall, what I would call market overvaluation, given, all sorts of different valuation metrics. Are you back to that point of concern here in terms of just general market valuations, or is it, you know, whether it's earnings growth or whatever, are you less worried now about where valuations are?
Not really. We're back. It's interesting. During the sell-off in April, about 14% of our companies all of a sudden got into a range where we were going to start to really looking at them really close. We did buy some, but we didn't have enough. They didn't stay there long enough for us to do what we needed. But if you look at it right now, you look at the general market, we're selling at 22 times forward earnings. Well, that's as full as you can go higher than that. Yeah, no question about it. But that is a very expensive market under any situation in your 27 or 28 times trailing 12 months. So none of that's cheap. I mean, cheap is 14 times or 15 times is kind of mid-range. And so that's one of the differences really now is that people don't really know what expensive is. So they just buy. They don't really think about what it is.
Well, and I think one of the things that's worrying about that, and I'm also going to pull up one of the charts you sent over here, Ted, but is that household stock ownership is basically at an all-time high percentage, right? So, you've got stocks very richly valued, as you just said, and you've pretty much got everybody in the boat at this point in time.
Everybody's in. And the reason I sent you this chart is because we overlaid it with debt to GDP. And you wonder why, since 2010, this thing has kept on running. Well, you just have to look at the red line, which is public debt as a percentage of GDP. They've just burned money. You put money out, and people spend it. And they just go all these programs and things like that, and that's pushed money in the system, and then people bought stock. And now, if you look at it, they're much higher than they were in 2000 at the top of that market. But I would also tell you, look back at 1982. Right now, they're up at 45 to 48%. But if you look back 82, they were 10. They were 10%. Households owned 10%. That's all they had. By the way, you couldn't give them a stock back then if you wanted. They wouldn't take it. But the other side of it, I wanted you to look at debt to GDP was 30. And so, it was a totally different, that's a cheap market. See, it's cheap in many ways. You got a lot of room to move here. But, and you'll look and see what happened all the way up to 2000. But here, it's different. You got a lot of debt. You're going to choke down the economy and choke down the GDP. You have to, because you have too much debt. And individuals can't see it. They just keep buying the indexes and pushing more money in the market. And if you look at the largest ownership in 401ks, it's the people that are 50, 60, and 70. They have all the money. And I feel for them in some ways because I don't think they're even thinking about, well, what could happen if I have something serious take place here?
So I was just going to mention that it would be really interesting to overlay another line on this chart, which would be average age of household investor. And my guess is that would be at an all-time high too.
Unquestionably. If you go look at it, it's going to be between 55 and 80. And there's probably a sweet spot in there is probably somewhere around 65 to 68. But, and it's, that's, I don't consider that real old, but it's old enough to where people are retired and they're forgetting about, I see so many of these people that are retiring and think, what I've made the last 6 or 7 or 8 years, I'm just going to extrapolate that into the future. And even if we just stay flat, like I talked about before, then it won't work. You're taking too much money out, and I don't think they're thinking about that.
Yeah, so you're bringing it full circle here. So back to the beginning. If you end up being correct here, and we have a prolonged period of volatility in the market, but over time, market doesn't really go anywhere. That volatility can also shake a lot of people out, right? So to your point, what was that magic number you said, around 68 or so, like that? Do you have the ability to kind of have a lost decade ahead of you, and a lost decade ahead of you with lots of points where you might just get pushed out of it? Your emotions force you to sell, at a low or whatever, right? I mean, there's a lot of people that don't have the time to recover from that.
Well, there aren't, and we have a lot of people that come to us that have too much stock, and it's very hard for us to take that account because we have fiduciary responsibility. And if you're 75, 80, 85 years old and you don't have a balanced portfolio, there's not much we can do for you because you may be right. Maybe the market really takes off the next 5 years, but my guess is over the next 5 years plus, you're not going to make more than 5 to 6% when you finally look at it at the end of a 5 year period. And again, you can go up and down, but I don't think you'll make a whole lot of that. And that's people forget about that. And you can make right now 4.3. We're getting in a 90-day, 6 month treasury. So you need to think about it a little bit.
So let's get real practical for a second here, Ted, because I think, a lot of the viewers watching this kind of fit in the demographic you're talking about. They're somewhere between 55 and 80. I know this from surveys of this audience, so I know I've got younger viewers too, but that's kind of the majority are in that range. So if they were to, call up Oxbow and meet with you guys, and you saw that they had what you would consider to be too much equity exposure or too much equity concentration given their age, just real quickly walk me through what you guys would do with them.
Well, we've developed some really good software over the years that we use with those people. And what happens is we try to give them an idea, okay, the way you're structured right now and what you're dragging from these accounts in terms of money taking out, the way you're structured, if in fact there's a 40 or 50% decline, you're in trouble. And we can show them where they're in trouble. Instead of you thinking the money is going to last 40 years, then hey, it may only last 20. And what you have to do is be able to put in the numbers to say, okay, we have confidence that, okay, we can give you the upside and downside, but you're going to have the balance correct. That's what we try to get over to people at that age. You got to have the balance right, because you all the things that can happen to you over 65, they include a lot of things. Spouse can die, you can get sick, things can happen to your children. There's all kinds of things go on, and you don't want the money part of it to be dragging you down right in the middle of some of that stuff going on. I think people forget about that. And so we try to give them, we run a lot of software, and we'll show them where, if you do it this way, okay, you may not have as much money as if you have a roaring market the next 20 years, but by the way, it will last you all the way. And that's what you're interested in.
Thanks. Yeah, no, I very much appreciate you being transparent about that. One of the things, and we've talked about this before, but one of the things people tend to get with the mindset is okay, well, I got to beat the market. I got to try to beat the market every year, right?
Yeah.
And the reality is, well, no, not necessarily. Like if you have a clear sense of what your financial goals are, one of the benefits of spending time with a good financial advisory firm like yours is to say, okay, well, given where you are right now, what do you need to make to get to those goals by the time you want to get to them? And you might need to make a lot less than the average market return. And that's great because you can reduce your risk, right? So you can totally increase your odds of hitting your goals with less risk and just sleep better. And to your point, of all the things that life could throw at you, you're minimizing the fact that it's going to throw financial surprises at you because you're able to, really kind of bulletproof. I don't want to oversell it, but really risk reduce the financial side. And the people that don't, it's like one of the greatest own goals, right? That people can perform on themselves, right? It's like fumbling at the goal line. Like why would you set yourself up to try to stretch for more risk than you need? Because if it ends up exploding on you or blowing up in your face, you create a crisis where you really didn't have to have one.
Well, it's like Pete Carroll in the Super Bowl, if you remember that, down on the 1 yard line. When all they had to do was run the ball across and they threw a pass. I don't know if you remember that. And anyway, it was disaster. They had the thing won. It's like that, okay? But I always tell people, remember this one word, Adam, optionality. If you give yourself options, and the only way you have options is to create some liquidity and some safety in that balance, but give yourself some optionality, because what you'll find is some of these times that are really tough, if you have some liquidity and things are in your favor, you can take a little bit of that and it will go a long way. And I'm telling you, and I think that's what I try to tell you people. It's like, give yourself some options, have some optionality in your portfolio, and you'll do a lot better over time.
All right, I've just written down optionality and I'm now underlining it several times here. All right, well, look, I've got one or two last questions for you, Ted, but let's start with this one. So given everything that is going on right now, as you guys look ahead for the second half of 2025. What's the general market outlook that Oxbow has? And I know you mentioned a couple of sectors and a couple of companies you bought recently, but in general, how is Oxbow positioning right now given that market outlook?
Well, for one thing, we would guess that the inflation rate would be higher in the third and fourth quarter. That doesn't mean it's 8%, but I'm talking about it moves toward 3%. And if that's the case, that throws a lot of people off in these markets. And I still think, again, you'll have these ups and downs, and maybe the ups are more than the downs. Sometimes that's the way it is. I think people want to believe that it's going to be better, and so and there's a lot of money around right now, so I could see them continue to put money in here before something really negative happens, and perhaps we get something and this tariff situation evens itself out. I don't know. That would be a catalyst for people to say, a lot of these companies will do better now that we understand what's happening. I don't know that. All I know is for us, if we have a company that hits the numbers we want, we'll buy it no matter whether we're at a market at 6,000 or 4,800 on the S&P or 6,500, because that company looks like to us we can make some money in it, and that's where we'll be. Now, I do think people too, in one of our strategies, we have a lot of commodities. I think people need to think about that the next 5 to 10 years, because real assets are the things. If you go back in the 70s, real assets were king. If you didn't own real assets, you didn't make any money in the 70s. It's very much like it is now. It's like a stagflation. And so if you look at that, I think people have to realize that you own, and a lot of people already own real assets. They own land, they own buildings, they own, they own metals, and that's great. They own oil and gas. I think that's fine. But I think that's where they'll have to go to at least have some of your portfolio exposed to those commodities, because it seems like the dollar will be declining, your debt will be going up, and a lot of the countries worldwide will be saying, you know what, it's not going to work for us. And a lot of those companies now, they're juicing their economies. They're putting the money out there. So you could put yourself into a situation where we inflate a little more than people expect.
Okay. All right. So inflation, I heard you use the word stagflation, but obviously if inflation keeps going up and if the economy starts to slow, they'll start bringing us back into that territory. All right. So you mentioned one of your models there. Remind me, I believe you kind of have three main models there at Oxbow, or three main different types of portfolios that you run. A, is that true? And B, if so, describe how each one operates.
Well, each one stands separately, but the most conservative one is called conservative fixed income, and it's done well over the years. It's actually done really well over the years. But what happens is it doesn't make as much money as the other two, and naturally it doesn't, because we keep a lot of maturity short. In other words, in that portfolio, everything's less than about 48 months right now, and mostly treasuries, but also for people in a high bracket, we use some really great tax-free municipal straight bonds. We don't buy the funds that are in those things as well. And in that portfolio, we also carry a position of 4.5% to 5% gold bullion, not the miners, but the gold. And that's just an offsetting currency thing for the dollar. It's worked out well for us over the years, but that's the reason we carry that. Then at the far end, the third one is really all stock, and it's all growth stock. We're not trying to buy companies that are just stodgy or something like that. We're trying to buy companies that can really grow over a 5 to 15-year period. And then in the middle, we have a strategy that we developed 1992 really did it for business owners, for selling companies. They wanted a lot of cash flow, but didn't want to be fully in the market. And that's called a high income strategy. And it does just that. It's a lot of cash flow and a lot of high income things are in it. Is it going to do what the market does when the market's up 20 points? No, but it will pay a lot of cash flow.
All right. It'll bring in more cash flow, obviously, than the conservative fixed income, because you're
Right.
taking a little bit more risk there. And in the all stock portfolio, I remember when we talked at the beginning of the year, yes, the portfolio invests in stocks, but you had a pretty relatively high percentage of that portfolio sitting in cash because you were concerned about valuations at the time. Is that still the case today?
It is. It's about 41% probably. It may not
Okay.
be quite as high as it was in January. We bought some things during April, and then last few weeks we bought some other things, and so it's not quite as high. It's probably 42, maybe 42%, 42, 43 maybe. But that's in treasury. We would use it though. I mean, if we get the prices on things, we'll buy them.
Okay. All right. Um, uh, so, obviously I sort of look at those as big levers, and based upon what you see the market doing, you can pull one lever more than the other, meaning like, oh, all right, it looks like, valuations are getting better for these stocks. Let's lean more into them, right? Vice versa. We're getting worried about valuations. Let's lean a little bit harder into the conservative fixed income. Let me ask you this as we start to wrap up here, Ted. I always love, you know, our discussions with you in general, given your seasoned market expertise and your wisdom. But I love near the end here, sort of just getting to a high level and bringing some real practical, uh, useful advice to folks, because you're just so willing to give it out. And it's one of the things I really appreciate the most about you. So let me ask you this. What do you see as the role of a good financial advisor? And the reason why I want to ask you that question, Ted, is because you've been helping clients for decades. I mean, what, over 4 decades? You've seen the good and the bad in terms of what the market can throw at people. You've seen the good and the bad at human nature, about mistakes that people can make, self-inflicted mistakes that they can make. So what lessons have you learned over your long tenure there of helping clients that you know give you a sense of if someone's looking for a good financial advisor to help them, which I think a lot of viewers are, what should they be looking for? Like, what does a good financial advisor do for these folks?
Well, there's a lot of good people out there too. Let me say that. But I think the number one thing you need to find is independent of thought. They have to be able to think independently, or they will continually be chasing whatever the street is just into, you see? And so what you want is independent of thought so that when they look at what they're investing in, they can think about it as an investment as opposed to everybody else is buying it, if that makes sense. And a lot of people in the business today, particularly say under 45 years old, are doing, they buy 10 or 11 or 12 exchange rated funds and think that everything's okay.
Yeah.
And that's really not, we don't consider that much of a financial advice. I think, I think that in itself, and it's worked. I'm not saying it didn't work, but see, that's, again, it gets ingrained in your thought. But you have to think about, I always think about it like this. I always say, look, what if it was your mother's few millions of dollars, if you were your mother, okay? And you think about, okay, now look, I need to take care of my mom here under in any circumstance, up, down, sideways, whatever. I got
Hmm.
to really think about this. Well, that's the way I would think about it if I were telling young people in the business to do it and say, look, think about it, okay? Don't just go out and do what everybody else is doing. You put your hat on, think independently about what's right for that person. And I think it'd go a long way toward making the right decisions.
All right. I cut my teeth in a big investment bank, a big branded investment bank, my first few years out of college. And, I saw, I didn't work on the retail side, but I could see the retail business. And you could see that the brokers there was a tremendous amount of pressure to push whatever the proprietary products were that the bank was creating, which is just another big reason why I think independence, not just of thought, which I agree is super critical, but I think I definitely have a bias to say people should seek out an independent firm, right? A firm that is clearly recommending whatever is in the client's best interest. They're not recommended what they're getting pushed on from the mothership to buy because it's the most profitable product that the firm offers.
You know, an example of that, though, I'll tell you, and I think people are making a really grave error on this, is private equity. If you look at private equity today, it's probably, in our opinion at least, is the worst thing you can do the next 10 years of anything we're looking at right now. My friend Dan Rasmussen wrote a great article for Financial Times over the weekend And I encourage people to read it because he's right on the money on this. Because when you look at what's going on in that business, it's a Wall Street makeup deal, okay, that's been made up to make you think that it's great for the next 10 years. It has a lot of pitfalls in it. And I think people, individuals particularly, tying money up when they can't get it out for a long period of time are making big errors on that part of the business. And see, that's another thing. You have to think independently about that, about when can I have liquidity? Well, who knows? And that's the point, in some of these things. And so you have to be careful of these alternatives.
Yeah, and again, that seems to be sort of one of the hot things right now, right? And not only is it a liquid, but it's opaque, right? I mean, it's just they just
Oh, totally. You're
marked a
right.
book or whatever, right? I mean, so you
Yeah.
sit there for years, basically. Well, how much is this thing worth? Well, it's right now we've got it valued in the books at X, but you have no idea if that's a true market value or not, and you won't know until there's a liquidity event, if you ever get one.
Well, until they make a sale. I talked to a lot of these young MBAs and they're at private equity firms and everything. And I say, hey, well, I asked them, have you sold anything yet? And I said, well, no, we're just waiting for these companies to get a little more mature. And I'm like, what that means is, I'll tell them straightforward, that means you can't sell it. That's
Exactly.
what that means.
It's funny. I was actually on a walk this morning with a friend of mine who is a consultant to a lot of startups and is basically was confirming that right now a lot of that capital, a lot of that investor capital, that VC capital, et cetera, is really stopping. The flow of it is slowing or stopping.
Yeah.
So to your point, I mean, there's a lot of people out there right now that are kind of trapped in these investments.
Yep. And they'll figure it, what's happening though is they're figuring it out. See, it's been long enough to where they're not getting any cash flow or not making any sales. But by the way, the private equity firm's still getting paid. So just remember that.
Yeah,
And
they
so,
still get their 2%. Yeah,
yeah.
exactly. All right. Well, look, uh, one last thing I'd just like to mention here. So I've had a couple of people recently reach out to me, and I know one or two of them have talked to your firm as well, where they're doing exactly what I counsel our viewers to do here, which is if you are a DIY investor and you feel good about that and you've got a good track record, like fantastic. I love the fact that you're watching this channel and trying to learn from our guests and hopefully are making more informed investment choices as a result. But for a lot of those people, they're in that age range that you talked about, Ted, the older age range, and they oftentimes are shouldering the investing responsibility for their family's financial wealth um, on their own. In other words, their spouse isn't involved, their children aren't involved. And so there's a key man risk there, right? That if they age out or if they suddenly get sick or God forbid an accident happens to them, uh, their financial dependents are going to be, basically kind of caught unawares. Oh my gosh, this guy was taking care of everything for us, or this woman was taking care of everything for us. And suddenly it's now dumped in our lap and we don't know what to do. In fact, we might not even know where this money is, where the accounts are, what the passwords to the accounts are, all that type of stuff. And so, I've talked to some people who have reached out and kind of woken up to this risk, and they've started the very least forming a relationship with a good financial advisor, so that to say, hey, look, I might still continue doing this on my own, but I'm trying to pick an advisor who thinks like me and that I'll feel comfortable with, that they're going to manage my money in the way that I would want it managed if I'm not around. And we can do this while I'm still alive and operational so that my spouse can get to know them. We can develop a relationship so that if and when I have to pass the torch on, willingly or unwillingly, I've got the comfort that this is all lined up so that my key loved ones are going to have a very seamless transition. And I know your firm, does this a lot, but this is really something a lot of DIY investors should be thinking about, correct?
Well, they should be. And I would tell you, in all my years in the business, I would tell you 10 to 15% of do-it-yourself investors are really good. They know how to buy companies. They've done it for a long time. They really know how to invest, and they're good. And many of those are friends of mine, and we exchange ideas for sure. But about 50% of those are people that have just come to the party in the last 12 or 14 years, And you can't really tell them anything. If you say, hey, you know what, because the first thing out of their mouth is, I've made X amount of money over this last 8 or 10 years, and I think I can do that the next 8 or 10 years. And they're living in la la land, because that doesn't work that way. That's not the way this business works. And I think for them, they need to just sober up a little bit and have a little humility, because believe me, I have a lot of it. I've been humbled down so many times in this business that I'm having to take lumps a lot. But you have to get to the point where you realize that, maybe part of my money, or have some part of my money, or maybe just look at the whole thing. I need to step back and get another opinion on that. Have somebody look at it.
All right. Yeah, folks, look, if you don't take my advice on this, I highly recommend that you take Ted's. It's just, again, it's one of those kind of unnecessary own goals if you don't have a succession plan like this lined up. It's something that a little bit of planning, not going to take a lot of time. You're going to sleep better. Your family's going to sleep better. But if you don't do it, the downside is just catastrophic in a way that's completely unavoidable, or completely avoidable. All right, Ted, last question for you. Your kind of what you built the business on there at Oxbow, if I remember correctly, is helping people that have had a big liquidity event, right? I mean, usually it's an entrepreneur, right? Somebody who their life was their company. They got up every morning, built this great business. Somebody came along and rewarded them and said, hey, here's a big pile of cash. Person accepts it. They wake up the next morning and they think, oh my gosh, I don't know what to do with all this money. I'm not a money manager. I'm, an entrepreneur who doesn't have a business anymore. And I don't know what to do with the money. And I don't even necessarily know what to do with myself right now. A, am I correct? And B, what can you tell that person?
Well, I would tell you, it's interesting. I've worked with business owners that have sold companies for 38 or 40 years, a long time, and they are wonderful people, number one, to work with. They are such fine people to work with. They fought the fight, done well in the company, they paid the price. And you're right about this. Typically, everything they had was in the company and had a little bit outside. And they may have had a stockbroker that carried a little bit of money. But when they get the real money I'm talking about, that's where we've really concentrated with them on what they wanted to do from here on out, because most of them are not going to start another company. Not all of them, some of them do. But we try to also counsel them on a lot of mistakes we've seen business owners make too after selling those companies. But we've written a lot about it. We've got 4 or 5 books just about that one topic. And I think though they're probably honestly, they're probably maybe my favorite group of people on the investment side to work with, especially first generation entrepreneurs.
Yeah, that's a great caliber of person. And anyways, I can see the match being a really great one. You mentioned your books. I know you write these books. Your firm is very generous in giving them away free to anybody who asks for them. So folks, if you want to, get access to any of these books, just reach out to Ted's firm and ask. Specifically, Ted, I let folks know about this latest book of yours, Second Generation Wealth, which is really all about raising sort of financially resilient children. And the response to that was tremendous. So thank you for giving away so many free books to those folks. And we're going to be doing a webinar in a couple of weeks. If I'm remembering correctly, it's going to be June 25th. We're going to do it at 7 p.m. Eastern. So folks, more on that to come. But if you want to get alerted when we start signing people up for that webinar, just go to thoughtfulmoney.com/newsletter, sign up for our free Substack, and that Substack list will be told. You'll get an email that has all the details and tell you how to sign up for the webinar and all that stuff when it gets a little bit closer. But again, I'm so glad that you wrote this book, Ted, and I know there's a ton of interest in that webinar. And it'll be interactive live Q&A, so folks, you can ask your own questions to Ted as well. And most importantly, if you have been watching this and are hearing some of yourself in Ted's answers here, whether you're a DIY person, whether you're an entrepreneur who's had a liquidity event or thinking you might have one coming up at some point in the future, or you just like the way in which Ted sees the world and thinks, hey, that might be a good guy I could benefit from. then feel free to schedule a free consultation with Ted and his team there at Oxbow. To do that, just go to thoughtfulmoney.com/Oxbow. I've also got that list right below this video as well. If you click that link, you'll go fill out a very short form, and the team at Oxbow will be in touch with you right away to see how whatever help they can be in your life. Ted, I can't thank you enough, my friend. Folks, please thank Ted yourselves by hitting that like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. But Ted, thanks so much. I want to give you the last minute here just to give any parting bits of counsel to the investors who watch this channel who are, again, just trying to figure out how to navigate this very chaotic market we find ourselves in.
Well, Adam, I go back to my term earlier, make sure you have some optionality in that portfolio. And if you're 90% stocks, you don't have much of an option. And so set yourself up. We wrote a great book called A Balanced Portfolio that people like, but it's about balancing out so that through anything that happens to you, you're going to be okay. You can sleep at night, you won't really hate yourself. And so that helps you get through these times that are all really good or bad. And I think that's the one thing I would mention to people to keep in mind.
All right. Well, true to form, Ted, very grounded, very sage, very wise. Thanks so much. Folks, make sure that you sleep well at night and go schedule one of those consultations with Ted's firm if you feel like that would be a good thing for you over there at thoughtfulmoney.com/Oxbow. Ted, I can't thank you enough, my friend. Look forward to seeing you at the webinar.
Okay, Adam.
All right, everybody else, thanks so much for watching.